Hello, fellas. We're just gonna watch the FOMC live here, so couldn't take a proper trade today because the retracement to our POI just happened throughout the session. So if you come into the stream, this is a continuation of our stream in the afternoon, and we are going to have a look at FOMC, which is going to be starting in 30 minutes from now. So we just watch the paint dry, watch price, and see what FOMC effects gonna be like. And yeah, we'll jump on charts, talk about a little stuff here and there, and get an understanding of where the economy is and what this entails for the FOMC in the cycle. So FOMCs are pretty historic from time. So this is not going to be any different. This is going to be impactful. This is supposedly going to be Jerome Powell's last FOMC as Fed chair, as we have a new Fed chair being picked by Donald Trump. No one has been nominated, but on top of the list is a former BlackRock's chief analyst or a finance officer, whatever role. But he played a major role at BlackRock, and he's hinted to be the top pick for Donald Trump on the new Fed chair. Now, a lot of people are just speculating that Jerome Powell is going to be dramatic today because he has nothing to lose. So he's just going to rip the band-aid open and tell us what we need to hear and what could be a bit controversial for the market. But a lot of people are on the hawkish side saying there's really not much to worry about. The economy is doing great, and whatever speculations you might have are the market is a bit expectant of that. We already have some movement in Nasdaq, so um, we're seeing it creating support in this 4 hour imbalance. Not really convincing yet, as any news release could come and take out all this liquidity before we continue pushing up. So, if you're on a trade here, reduce your size, tighten your stop loss as we approach 8 p.m. I expect some spikes on both directions and, spikes into some POIs. I've marked some POIs on a higher time frame. This apart from these 4 hours, we have this 4 hours which was filled yesterday, but we could still come back to it again. And we have another one all the way down here. So it all depends on the volume that kicks in during that volatility. We also had some trader weights shut down today. So not a lot of traders managed to take a position today. And I think trader weight is still down. They already sent me a message that the account is back up, but I'm still seeing some warnings online that they said it's not going to be ready until the close of markets today. So I'm not going to force anything yet. So yeah, we're beginning to see some little volume kicking, but nothing significant yet. I would say de-risk your positions at the spot and manage your risk because anything could happen. So yeah, FOMC is coming up. Wherever you're watching from, thank you for joining. Just trying to grow this channel, do a little stream here and there. When I'm not trading, it's a bit boring. It gets crazy boring. So this is a kind of way for me to fill my time. So I'm not doing this to sell mentorship or any membership to any channel. This is strictly for educational purposes, just for me to come online here, build a community, see how far we can go with this, and I'm really enjoying it. So please leave a like, share, subscribe, help me grow the channel, share to your friends and family, and yeah, leave a comment. That helps the algorithm push the page out there. So let's see how far we can grow. So yeah, welcome again. And this is Edge FX. My name is Adimara Chika, and this is our stream for FOMC. Welcome. Let me try and put some music so it doesn't get too boring in here. The best opportunities are going to come just after the release, so no need to rush. You just chill and wait. So now we have a split screen, and on one side I'll be showing the Jerome Powell speech, and on one side okay. So on the long time frame, we're seeing some reversal patterns, not convincing yet, but we have some momentum building up there. So we'll see if FOMC guides the direction or it spikes like it normally does. So FOMC releases would normally spike both buyers and sellers, weak out the premature entries, and then the real entries can come. So let's see how it plays out. To be honest, I hate days like this. Days like this, I wish FOMC happened like in the morning. Like, why can't we have FOMCs in the morning session? and just have a day. Because what this has done is that it's just created a very low probability conditions in the market for today. So that if you manage to get something today, yeah, you're a big deal. You know what you're doing. But for most people, it wasn't pleasant. For me, I couldn't take a trade because of trade of it. Even the setup I had, which was a very minute setup, it's actually crumbled. So, but I didn't manage to take a trade. So maybe that's good riddance. Maybe that's God's way of protecting me from. So yeah, I'll also be using I'll also be using Bookmap to track our orders, see where the big orders are seated. This is today is like the Super Bowl of the financial markets. So after tonight, tomorrow would probably we'll see how well we're doing. But one thing I can guarantee is that at the end of today, all the stocks are gonna rally. Yeah, they're gonna rally. No doubt about that. And the way we've been reacting of this POI of mine, man, I'm so tempted to just slap in some heavy risk position because I can anticipate I'm anticipating that price would push us right up. But the thing with FOMC is that it would take out early buyers before pushing. So I'm hoping that doesn't happen today. But if it does, yeah, we're prepared for that condition as well. Hopefully one day this channel grows. For now, it seems like I'm just all alone in this stream. Uh, but it's helping me build mental strength because streaming and trading is not, it's quite tedious. So it takes a lot of pressure off me just vibing on the stream and doing that alone. So that would help me build confidence over time. Yeah, I have a case of astigmatism, so that's why I'm putting on this orange glasses because it makes staring at the screen very easy. It doesn't strain the eye. It blocks out blue lights, and yeah, that keeps your eyes unstrained for a long period of time. It's very comfortable. It's makes it a whole lot easier to look at the screens and the lights. So Yeah, trading is hard. I mean, I've been seated here all practically since 2:30, which is like 9:30, 8:30 Nigerian time, 8:30 New York time. So I've been here for a better half of the day. After I did some chores in the house, you know, got my meals prepped. So I've been doing this thing where I cook enough to last me for a week or two, and I store it in the freezer. And each time I need to take a meal, I just go and microwave one pack and have lunch or breakfast. And it's also portion controlled, so I don't eat way too much. Yeah. So so 2:30. Uh, so that's about 1 hour 20 minutes from now. So we're just gonna leave the stream live. I might disappear on the screen from time to time, but I'll still be here watching from. So yeah, I'll just keep the stream on for now.
Ian, and I work for the Federal Reserve, the central bank of the United States. The Federal Reserve System consists of three main entities that perform key functions that serve the public and promote the health of our economy and the stability of our financial system. These key entities are the Federal Reserve Board of Governors, 12 Federal Reserve banks operating around our nation, and the Federal Open Market Committee. Based in Washington, D.C., the Board of Governors is the governing body of the Federal Reserve System. It's an agency of the federal government that reports to and is directly accountable to Congress. The board consists of 7 members, or governors, who are nominated by the President of the United States and confirmed by the Senate. Governors are appointed for 14-year terms. The Board of Governors oversees and sets policy direction for the system, including 12 Federal Reserve banks located around the country, which take the pulse of the nation's economic health from a regional perspective. The 12 reserve banks represent different geographic regions, or districts, and were set up based on regional economic considerations. Although supervised by the Federal Reserve Board, the reserve banks operate independently in many respects. The reserve banks carry out a number of core system functions, such as supervising and examining commercial banks and other financial institutions, enforcing compliance with federal consumer protection and fair lending laws, while promoting local community development and lending to depository institutions to ensure crucial liquidity in the financial system. They and the board also play a key role in another primary Fed function, fostering the safety and efficiency of our nation's payment systems, including distributing currency and coin to banks, operating electronic payment systems, and clearing our checks. In addition, the reserve banks act as the government's bank, providing services such as maintaining the Treasury Department's transaction account and issuing and redeeming U.S. government securities. They also act as a bank for banks by providing key financial services to banks, thrifts, and credit unions. The reserve banks also provide a wealth of information on conditions across the nation, information that is vital to formulating a national monetary policy that helps maintain a healthy U.S. economy and a stable financial system. The board and the reserve banks together help ensure that consumer and community voices are heard at the central bank through consumer-focused outreach, research, and analysis. This helps keep the Federal Reserve's actions, policies, and decision-making attuned to what's going on in American households, communities, and businesses, which are the foundation of our economy. The third key Fed entity is the Federal Open Market Committee, or FOMC, which brings together representatives from the board and the reserve banks to consider the state of the U.S. economy and set a course for our monetary policy in a manner that seeks to promote an economy that works for all Americans. The 12-member FOMC establishes an appropriate position or stance for monetary policy to help move the economy towards 2 essential mandates set for the Fed by Congress, promoting maximum employment and price stability. This occurs mainly through the FOMC's influence on interest rates and credit conditions, which can significantly impact financial conditions, including economic productivity and even spending and investment decisions by households, communities, and businesses. Working together, these 3 key Fed entities and the unique Federal Reserve System structure established by Congress more than a century ago help promote conditions resulting in a strong, healthy, and sustainable economy. For more information on how the Fed functions, visit federalreserve.gov and click on About the Fed.
Across the United States, the Federal Reserve, through its Federal Reserve Education Program, helps people understand how the economy works so consumers have the tools to make sound financial decisions. Through this education program, teachers have access to classroom-ready online resources for students from kindergarten to college, videos, classroom lessons, online education, publications, and more. These resources are all free for educators to use in their lesson plans, or as they see fit. Many of the Federal Reserve System's regional reserve banks, located in 12 districts across the nation, also offer in-person and online professional development that allows educators to deepen their knowledge and hone their craft when it comes to economics, personal finance, and more. At the board and reserve banks, students also get hands-on opportunities like internships and participation on student boards, which introduce them to key economics concepts and potential careers in economics and finance. Consumers are empowered to make sound financial decisions through the availability of easy-to-understand resources that explain personal finance concepts, the broader economy, and the Federal Reserve's role in it. Federal Reserve Education is committed to equipping educators, educating students, and empowering consumers when it comes to understanding and participating in our evolving economy. For more information, visit federalreserveeducation.org to find links to resources and Reserve Bank programs offered near you.
Asian session after this close is gonna be epic. So I'm probably gonna stay up for Asian session tonight because yeah, um, I can I can anticipate some amazing opportunities by that time. So, as I said earlier, if you're holding a position before this FOMC, it would be great to de-risk or just completely stay out. We could see price rally from this point of interest that I've marked out. Price has, if price wanted to break down below there, it would have done that a long time ago. But with FOMC release, there's always a spike that takes out both buyers and sellers. So even though I'm bullish and I'm anticipating that this price continues to rally, there's a strong possibility that price could wick down and take out most of the early buyers before pushing up. So that's something to have in mind. So don't expect things to just be one-sided and just rip up immediately Powell starts speaking. So yeah, so that's something you should note. So I would generally advise waiting 15 minutes after FOMC release. You would see the best opportunities then. So no matter how pushed you are, no matter how uncomfortable, or no matter the FOMO you're feeling right now, it can wait. It's just waits for a couple of hours, 1 hour, 2 hours, and you'd have a better direction and a better trade to take. So let's wait. It's almost 8 p.m. now, but after Powell starts speaking around 8:30, so we've got about another 30 minutes to wait. So let's chill and wait. Yep. So that's this decline you just saw now was from a news release that the Federal Reserve has announced that officially they've paused interest rate cuts for the first time since July 2025. So that is a market reaction to that. So evidently, short term, it spells bad for stocks, but overall, we are incredibly bullish. What this spells is that the Fed has seen that the financial data is extremely strong. Inflation is down. The economy is doing great. The job market, the labor market, and so what this entails is that stock prices are going to continue pushing, continue rallying as they have been. But the only thing that could be a cause for concern is that any news release we have now is going to have a significant impact on the stocks, because that's what the investors will be looking out for now, knowing that there's no rate cuts coming. The next attention people would be focused on are the economic data that will be coming out from now on. So like your NFP data, your PPI, and all sorts, consumer your CPIs as well. So yeah, it's just interesting that we're getting this before the speech. But yeah, this spells good for stocks. Overall, it's healthy. These stocks are going to continue rallying regardless of this. But like I said, would have some short-term spikes, sweeping out early buyers, and yeah, but we're going to continue rallying with this in mind. So this is first good news, and we'll see how the market further reacts as we approach 8:30. But this signifies that we're going to have some sort of we're not going to have a dramatic um, event anymore. So a summary of the Fed decision. They've halted rate cuts for the first time. They say inflation remains elevated, and two Fed governors' dissents are in favor of a 25 BPS cut. Unemployment rate has shown some signs of stabilization. Fed reasserts goal of achieving 2% long-term inflation. And uncertainty about economic outlook remains elevated. Everybody knows that. So, um, December may have just marked Jerome Powell's final rate cut. Yeah, Jerome Powell had been the face of our trading for the past couple of years. So it'll be interesting to see who comes on next and what the person's outlook is. Evidently, I would prefer a Fed chair who actually is independent and not necessarily doing the bidding of Donald Trump. That it's not really good for the markets. But it's safe to say that Jerome Powell has really been in a. I feel like this little financial crisis or episode we're having right now, it should have happened a long time ago. But because of people like Jerome Powell, they've been able to hold the economy in such a way that things didn't go haywire, because things could have gotten out of hand during Biden's administration, but this guy really kept it together. So that's something worth noting. We need an independent Fed chair next. We wouldn't want someone doing Donald Trump's biddings, but it's yeah, overall we're seeing good signs for things to come. It's January, so yeah, it's exciting. It's exciting. So we're not really expecting any bad news for stocks. We could have some short-term decline, maybe when the news comes, when the speech starts. But yeah, we'll see. Yes. For people who are not interested in trading or whatever, this might seem very boring. So I'm quite confident that I might not get as much views as I want because I know these are not the kind of content that people like, but I'm actually doing this for the fun of it. I love it. I enjoy it. I enjoy talking about finance. I'm still um, getting educated about how finance works and the economy and all. But it's been a very great unraveling experience. So I don't really care if we don't have numbers here. I genuinely enjoy coming to this place to stream and just talk about this. So even if it's just me streaming for years, I'm okay with it. But if you're here, welcome. You're very much welcome, and we have a lot of exciting things to do. So let's see what the market gives. Yeah. Yeah, we've been in this POI. This POI seems to be holding on really strongly. So um I really like the way it's been holding up. I really like the way it's been holding up. So yep. So we've got about 20 minutes to the speech. Exactly 20 minutes. Just stay off this price action. If you don't want to hurt your P&L tonight and sleep in a bad mood, just let this sleep for now. What's up, fellas? 1 minute to the stream, to the sorry, to the speech. So let's see what Christmas lights pop up. Like I said, I expect that would push down, would have a decline, an initial decline, before we now continue pushing up. So let's anticipate that. But I'm still bullish regardless. So I'm just chilling, waiting for buys to form. No matter how long this market tanks. Yeah. Yep. It's time. So you're going into this, we already know no rate cuts. So the economy is healthy. All right.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. The U.S. economy expanded at a solid pace last year and is coming into 2026 on a firm footing. While job gains have remained low, the unemployment rate has shown some signs of stabilization, and inflation remains somewhat elevated. In support of our goals, today the Federal Open Market Committee decided to leave our policy rate unchanged. Having lowered our policy rate by 75 basis points over the course of our previous 3 meetings, we see the current stance of monetary policy as appropriate to promote progress toward both our maximum employment and 2% inflation goals. I will have more to say about monetary policy after briefly reviewing economic developments. Available indicators suggest that economic activity has been expanding at a solid pace. Consumer spending has been resilient, and business fixed investment has continued to expand. In contrast, activity in the housing sector has remained weak. The temporary shutdown of the federal government likely weighed on economic activity last quarter, but these effects should be reversed as the reopening boosts growth this quarter. In the labor market, indicators suggest that conditions may be stabilizing after a period of gradual softening. The unemployment rate was 4.4% in December and has changed little in recent months. Job gains have remained low. Total non-farm payrolls declined at an average pace of 22,000 per month over the last 3 months. Excluding
Support
government
still
employment,
holding strong.
private payrolls rose at an average pace of 29,000 per month. A good part of the slowing in the pace of job growth over the past year reflects a decline in the growth of the labor force due to lower immigration and labor force participation, though labor demand has clearly softened as well. Other indicators, including openings, layoffs, hiring, and nominal wage growth, show little change in recent months. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index indicate that total PCE prices rose 2.9% over the 12 months ending in December, and that excluding the volatile food and energy categories, core PCE prices rose 3.0%. These elevated readings largely reflect inflation in the goods sector, which has been boosted by the effects of tariffs. In contrast, disinflation appears to be continuing in the services sector. Near-term measures of inflation expectations have declined from last year's peaks, as reflected in both market and survey-based measures. Most measures of longer-term expectations remain consistent with our 2% inflation goal. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 3.5 to 3.75%. Since last September, we have lowered our policy rate 75 basis points, or 0.75 of a percentage point, bringing it within a range of plausible estimates of neutral. This normalization of our policy stance should help stabilize the labor market while allowing inflation to resume its downward trend toward 2%, once the effects of tariff increases have passed through. we are well positioned to determine the extent and timing of additional adjustments to our policy rate based on the incoming data, the evolving outlook, and the balance of risks. Monetary policy is not on a preset course, and we will make our decisions on a meeting-by-meeting basis. To conclude, the Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We at the Fed will continue to do our jobs with objectivity, integrity, and a deep commitment to serve the American people. Thank you. I look forward to your questions.
Hi, Chris Rugaber at Associated Press. Thank you. I wanted to ask that, you attended the Supreme Court hearing last week on the Lisa Cook case, and Treasury Secretary Scott Bessent criticized that as political. Can you say why you attended and what you would say in response to the Secretary's criticism?
So let me start with, I don't respond to comments by other officials, whoever they may be. It's just not appropriate to do that. I will tell you why I attended. I would say that that case is perhaps the most important legal case in the Fed's 113-year history. And as I thought about it, I thought it might be hard to explain why I didn't attend. In addition, Paul Volcker went to a Supreme Court case famously in, I guess, 1985 or so. So it's precedented, and I thought it was an appropriate thing, and I did it.
Great. And then just quickly follow on the job market. You mentioned last month that the household survey might be distorted, and you also mentioned the potential for overcounting jobs, which would suggest that we're still in a negative hiring pace. So do you see the drop in the unemployment rate as solid? And what's the basis for saying that things have stabilized? Thank you.
So, yeah, really two questions. One is, so we're getting through the distortions in the data from the shutdown. However big they were in November, they're smaller in December. So we're getting to a place where they're no longer material. They're still there, but it's a tweak here and there. The reason why we changed the statement, let me pull it out, was simply, it used to say that judges that downside risks to employment rose in recent months. So we saw, data coming in which suggests some signs of stabilization. I wouldn't go too far with that, but some signs of stabilization. There are also some signs of continued cooling. And so we thought that was no longer an accurate description of the data. In addition, the outlook for economic activity has clearly improved since the last meeting, and that should matter for employment over time. So for those two reasons, we thought we would take that language out of the statement.
Nick Timrose, The Wall Street Journal. Chair Powell, you've generally avoided engaging with political controversies directly, and the video statement on January 11th was a departure. What made this different, and are you concerned it could draw the institution further into political debates?
So today I'm simply going to refer you to the statement that I made on January 11. I'm not going to expand on it or repeat it. So I'm just not going to, this is really about the press conference and the economy and what we did today, and some ancillary areas, but I'm not going to be getting into that.
Can you say whether the Fed has responded to the subpoenas?
I have nothing for you on that today.
Mike.
Michael McKee from Bloomberg Radio TV. Have you made a decision on whether you would remain as a governor of the Federal Reserve? And if so, would you tell us what it is? And if not, when might we anticipate a decision?
No, and I really, once again, have nothing for you on that today. That either.
Why would you want to leave at all under the circumstances?
Again, I don't want to get into this. Not something I'm. There's a time and place for these questions, but not something I'm going to be getting into today. Thank you.
Thank you. Claire Jones, Financial Times. Thanks a lot for taking my questions. In another one that might, lead to a similar answer. We've seen quite big movements in the dollar over recent days. What do you think is driving the US currency lower? And have you been at all concerned just by the extent of the volatility we've seen this week? Thank you.
So, Claire, as you probably know, we don't comment on the dollar. Really, the administration, especially the Treasury Department, has the job of oversight over the currency and exchange rates and all that. We don't comment on that. It's not our role. So I have nothing for you.
But, what's your view on the market movements? What do you think behind them? Is it asset managers diversifying? Is it?
Yeah, I just don't. We don't talk about the dollar. We don't talk about what moves it around. It's just not appropriate for us to do so. Really, the Treasury Department has that. It's their role, their bailiwick, and we stay off it. We do monetary policy and some other things, but we don't comment on the dollar. Sorry.
Neil.
Hi, Chair Powell. Neil Irwin with Axios. Obviously, no SEP in this meeting, but in light of the slight firming up of the language around growth in the labor market in the statement, should we assume that the timeline for any further rate cuts is pushed back compared to what people might have thought in December?
Well, first of all, if you look at the incoming data since the last meeting, clear improvement in the outlook for growth. The data have come in, and sentiment, the Beige Book, everything comes in suggesting that this year starts off on a solid footing for growth. Inflation performed about as expected, and as I mentioned, some of the labor market data came in suggesting we're evidence of stabilization. So it's overall a stronger forecast, really, if that's your question. I'm not sure I answered your question.
But in terms of timing or pacing of any additional easing?
So we haven't made, what we'd say about this was that after this meeting, after the 3 recent rate cuts, we're well positioned to address the risks that we face on both sides of our dual mandate, and we'll continue to make our decisions meeting by meeting based on the incoming data, the implications for and the outlook and the balance of risks. Haven't made any decisions about future meetings, but the economy is growing at a solid pace. The unemployment rate has been broadly stable, and inflation remains somewhat elevated. So we'll be looking to our goal variables and letting the data light the way for us.
Steve.
Steve Leisman, CNBC, and sticking with questions you might answer, thank you. You had previously, I believe, described the current policy rate being at the higher end of neutral. And if you look at the longer run, the SEP and the longer run rates, 16 of 19 officials are actually below there on their long run. Is the Fed still in a process of bringing it down towards a middle range of neutral? And what would it take to get there?
So the count I did was that 4 of the 19 were at or above that. Maybe I missed by 1, but I thought it was 4. And if you look at the dealer survey, it was 10 out of 58 where we're at or above. So you're right. It's the higher end of the range. What we say is it's within the range of plausible estimates. This is the higher end of that range, but so for some people they think it's neutral. I think, and many of my colleagues think, it's hard to look at the incoming data and say that policy's significantly restrictive at this time. It may be sort of loosely neutral, or it may be somewhat restrictive. It's in the eye of the beholder, and of course no one knows with any precision. If you had a follow-up.
I get what you're saying, but some officials have described the Fed being in a mode of bringing it down eventually over time. Are you still in that mode, or is this a place to hang out?
Yeah, no, I would say if you look at the SEP from December, most people had additional normalization. But at the same time, we've done a lot of the process of normalizing. A good piece of it is done with 75 basis points, and before that, 100. It's 175 basis points we've cut since we began cutting in September of 2024. So you've moved now to, Fed funds is running just a little below 3.65%. So you've moved a good way, and we think we're well positioned here to watch how the economy performs, look at the data. We're not making decisions about future meetings, but we do think we're well positioned after those 3 cuts to let the data speak to us.
Amira.
Thank you, Chair Powell. Mara Mokway from Bloomberg News. To what extent did the committee discuss the possibility of cutting at this meeting or in March? And how are you all thinking about the conditions that would merit another rate cut? Is there broad agreement on the committee about what it would take?
So there was broad support on the committee for holding today. Broad, I would say, including among non-voters. So that's where that was. Of course, some people did want to cut and dissented, but committee pretty broadly for holding today. We're not trying to articulate a test for when to next cut or whether to cut at the next meeting. What we're saying is we're well positioned as we make decisions meeting by meeting, looking at the incoming data, evolving outlook, and all that. And we're in a position where we still have some tension between employment and inflation, but it's less than it was. I think that the upside risks to inflation and the downside risks to inflation have probably both diminished a bit. So, we'll be looking at that. It's about how you weigh the risks to the two goals and how big those, and quantify them. And so there are different views on the committee, and, we'll find our way forward as the data evolve.
Thank you, Mr. Chairman. Edward Lawrence from Fox Business. Has the effects of tariffs already moved through the economy on prices?
A lot of it has. So basically, there are many different estimates, and they're all highly uncertain. But most of the overrun in goods prices is from tariffs. And that's actually good news, because if it weren't from tariffs, it might mean it's from demand, and that's a harder problem to solve. We do think tariffs are likely to move through and be a one-time price increase. So most of the overshoot, if you were to take that out, inflation, core PCE inflation is running just a bit above 2%, ex the effects of tariffs on goods. And the other good news is, if you look away from goods and look at services, you do see ongoing disinflation in all the categories of services. So that's a healthy development. So that's what's going on. The expectation is that we will see the effects of tariffs flowing through goods prices, peaking, and then starting to come down, assuming there are no new major tariff increases that are begun. And that's what we expect to see over the course of this year. If we see that, if we see that, that would be something that tells us that we can loosen policy. Also, if we see something that suggests that the labor market is not stabilizing, that in fact the downside risks reemerge, or the data just get worse, we'd have to look at both of those. We have a two-sided mandate.
If I could, if President Trump does pick a new Fed chairman before May, what does that look like? How would you work with that person, and what does that transition period look like?
I don't have anything for you on that. That will depend on Congress's actions and things I can't speculate on.
Howard Schneider with Reuters. Thank you for taking our questions. Given the changes in the statement and all you've said so far, is it fair to describe risks to both sides of the Band-Aid as roughly balanced right now? And is the next move necessarily down?
I'd say that the upside risks to inflation and the downside risks to employment have diminished, but they still exist. So there's still some tension between the mandates. Are they fully in balance? Hard to say. And we think our policy's in a good place. I've just discussed reasons why we might change our policy, and we'll just have to see how the data lead us.
I'm wondering, a minute ago you said you felt expectations were consistent with your mandate, that the 2- and the 10-year break-evens have moved quite notably in the last couple of weeks, I believe. Is there any concern on that front?
I mean, I recently looked at all of the both survey and market-based short-term inflation expectations have come way down. They were in a good place at the beginning of last year. They spiked around Liberation Day, and now they've fully retraced in the last few months. So that's very comforting. And the longer-term inflation expectations have remained in places that are very consistent with 2% inflation over time. So expectations are have been solid, and they reflect, confidence in the return to 2% inflation.
Andrew.
Apologies if this is a little bit repetitive, but in the past you've said that the reason you cut rates was that the risk to the labor market was greater than the risk to the inflation side. Is that still true?
We haven't made, you're right, we saw the labor market weakening and we acted. And I think that was the appropriate thing to do. We will always act to address what we see as the economy moving away from our goals. Risks to both of the variables are a little less. I think the upside risk to inflation, again, a little bit less, and the downside risk to employment, a little less. I just would say that I'm not making a judgment about how, one of them is more at risk than the other, just that the risks to both of them have diminished.
Okay, thanks. BIS wrote a paper last summer which concluded that global investors were hedging their dollar exposures in ways that previously they hadn't because of policy uncertainty. Do you agree with BIS?
We really don't see much at all about that whole story. There's just not a lot of data that suggests that there's much to that.
Thanks.
Anna Swanson with the New York Times. Can you talk more about what you would need to see in the labor market to conclude it's time to resume easing? Do you need to see further deterioration in the labor market, or would it be enough for inflation to soften?
So we'll always be looking at both things. And so there could be combinations, infinite numbers of combinations that would cause us to want to move. Certainly, a weakening labor market would be an argument for loosening. But what's happening with inflation? If inflation were at the same time getting worse, you just have a very difficult situation there. So we'll be looking at both. Clearly, a weakening labor market calls for cutting. A stronger labor market says that the rates are in a good place. We'll have to be making similar judgments, too, on inflation, though.
And if inflation does pick back up and the labor market doesn't show further signs of deterioration, is there a chance that you could raise rates rather than simply remaining on hold? What would you need to see to consider hiking?
We don't take things off the table, but it isn't anybody's base case right now, anybody's base case, that the next move will be a rate hike. But, ultimately we'll do what we think is the right thing. But that's not where people's expectations are right now.
Victoria.
Hi, Victoria Guida with Politico.
So yeah,
I wanted to ask you, you've talked in the past
the most
about
important part of the
concerns
news is
about US
done.
fiscal trajectory,
So I
and
think
we've seen in
the markets
Japanese
can
bond
continue
market a lot
rallying
of
now.
turmoil recently, in part due to concerns over their fiscal and
I'm already on
long-term
this
economic
trade on
outlook.
multiple accounts, so
Do you
I've
worry
set
that
break
the U.S.
even.
could at some point find itself in a similar situation to Japan,
Couldn't take it on my
whether for
prop
fiscal or
account
demographic
because
reasons?
trade of it is down for
over
the day,
time,
so
you've seen
I'll
that
just
US
take it
rates
on the
have
little I
remained
can, on the little accounts I
they haven't
could.
moved a lot. Really for a
So
while,
if it
but
goes
they haven't
against
moved a
us,
lot, because of
then
what's
all the
happening
wait
in
has been
Japan.
in vain, and we'll call it a day. But
it's
I'm already
more
on
of an
this trade, and
overtime
I'm
thing.
expecting that
The
we'll
US
just
federal
continue
budget
rallying to
deficit
all-time
is,
high. Once we
uncontroversially
break
unsustainable
above
path.
this
The level
zone
of
that
debt
I
is
marked
not
here, so
unsustainable.
we
It's
need
very
to
much
mark.
sustainable, but
We
the
need to
path
break above
is
this zone here.
unsustainable. And the sooner we
Continue
work on
pushing.
it, the
So
better.
yeah.
But
Anyone who came to
right
watch the
now,
stream,
we're
I'll
running a
just
very
end
large
this here for now. That's we've got important bits. So yeah, this is the entry, and I'll just hang around a bit and log off the stream and see how it goes. But yeah, this is it. So thank you all for watching, wherever you're watching from. I'll just let this stream play in the background, and I'll see you guys in a bit. got market close in 2 hours. So let's see what price can do within that 2 hours. All right, fellas, I gotta jump off the stream. It's already late, but if you're holding this position, you can hold it overnight. I'm holding it, so you can. On that note, I'll update you guys as we progress, and I'll see you guys tomorrow on the stream. Have a great one. Thanks for tuning in wherever you're watching from, and I'll see you.